So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again, and welcome back to The Daily Call. On today's call, I want to answer the question, why did my option move as much as the underlying stock? This is a popular question, actually. In fact, I think it's one that's just very common if you're new to trading options. But honestly, if you've been trading options for a while, you still might question this. And here's where this really comes from, or here's the setup that this comes from. So let's say that you are long a call option on a stock at $50 and your strike price is at $50. And so naturally, most people think that because your strike price on your long call options at 50 and the stock is at 50, that any move higher in the stock is going to see an exponential or at least a one-to-one move higher in the option contract that you're long. So the next day happens and the stock moves $2 higher. So the stock moved $2 higher, but now your call option dropped in value. And this is where people go crazy. They literally start pulling out their hair. They have no idea what's going on. And there could be a couple things that have caused this. Really, there's mainly two things that might have caused this. One is implied volatility. That's the biggest factor. We know that that's the biggest factor because that's where we get our edge in option pricing, is that this implied volatility, this future expectation that's baked into these option contracts, has everything to do with how much they change in value from a given day or given month or week. And so what could have happened with your contract is that even though the stock moved $2 higher, which was a big move, right, for a $50 stock, that could have been after an earnings event. So after earnings, implied volatility drops dramatically. Sometimes we've seen 50, 60 points move down in volatility. And so even though the stock went higher, the implied volatility just got sucked out of the contract. And now, even though you made money on the move higher, the delta move higher in your long contract, you lost even more money on implied volatility decaying or basically evaporating in the contract. That's why we say that you want to be a seller of implied volatility, because that edge is always greatest. It's very, very hard to consistently buy options and get it right and still pay the implied volatility premium that's in the market. That'd be like trying to buy insurance on a house knowing that a hurricane was going to consistently hit the same area over and over and over again, or knowing that the house was going to burn down over and over and over again. That's what you're trying to do with option contracts. You're trying to buy insurance, hoping that something is going to go crazy and you're going to make a lot of money. It doesn't really work out that way. You could get lucky for sure, but it's not a consistent way to run a business. So that's the first thing. You could see implied volatility drop, which is why your option contract didn't move as much as the underlying stock. The second thing that could have happened, and this usually happens more over the course of a couple days, but could still happen for sure, is you get time decay that's starting to erode out of the contract. So the way that I visually think about time decay is I think about time decay as a slow drip from a bucket of water. And so the bucket and the water are your option contract with all the value that's built in there. And at the bottom of every bucket is a hole, and that is time decay. And time decay slowly erodes the value. The water starts slowly dripping out of the bucket and starts eroding the value of that contract. No matter what happens, no matter where the bucket goes, no matter where the stock goes, right? That is always there. It's always present. And moreover, it's increasing. So it has an exponential feature that it starts to speed up as we get closer and closer to expiration. So what people often have trouble with in trading options when they get started is just realizing this extra or these extra dimensional features of pricing. It's not linear anymore. It's not like a stock where if the stock goes up by $1, you make $1. Now you have to price in these ulterior pricing, like dimensions, really, like these alternate dimensions of volatility and time decay and how that impacts the options price. But really, it's very simple to understand. We've kind of explained it here, and we've got other training on the website that helps. But hopefully that kind of gives you a basis for, how that might happen. So again, we get this question a lot. So hopefully that helps you answer the question. It could be two things, mainly volatility and time decay. So make sure you check those with your contracts and always be selling options. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.